Gold is trading at 4,482 and it is crashing through every single near-term moving average. The weekly chart is screaming sell. The daily is a strong sell. The 4-hour is a strong sell. The 1-hour is a strong sell. And yet, there is one number that could turn this entire momentum structure into the most violent bear trap we have seen this quarter. If you are staring at this price action thinking the trend is obvious, you are about to step into a minefield. Today I am going to show you exactly where the danger zone sits, where the hidden opportunity lives, and I am giving you 3 precise trade setups with entry triggers, stop losses, and multiple targets you can execute right now. There is one level that dictates everything. Write this number down. 4,444. If we lose 4,444 today, the structure shifts from correction to capitulation. If it holds, we are about to witness a trap that punishes late shorts and reignites the inflation supercycle bid. Stay with me, because most traders will skip the strategy section, and that is exactly where money is made. Right now, my instant market verdict for gold in this session is that we are fading every rally until proven otherwise. The intraday bias is a continuation fade. Sell strength, do not chase breakdowns. The market is trending lower within a descending channel on the 4-hour, and every pop toward dynamic resistance is getting slapped. The invalidation level that proves this bearish bias wrong is a daily close above 4,653. That is the key resistance we must watch. If buyers manage to reclaim 4,653, the entire sell-side structure cracks open, and we flip to a reversal chase. But below that, the trend is controlled by sellers. Write this down, interact with me now. The number that changes everything is 4,444 on a 4-hour candle close. If we see a 4-hour candle body close beneath 4,444, the whole floor gives way, and I will immediately shift my target to 4,409 and then the 200-day moving average down at 4,377. Comment that number right now. 4,444. If you are watching this later, tell me in the comments whether that level held or broke, and how you traded it. I read those comments daily. Now let me walk you through the technical architecture from the top timeframes down to the session chart. On the weekly, we have a clear bearish engulfing pattern that printed last week, closing firmly below the 10 and 20-week moving averages. The 50-week moving average is sitting all the way up at 4,681, and price is now nearly $200 below that. This is not a dip buying pullback within a raging bull. This is a structural change of character. The weekly MACD has rolled over and is accelerating into negative territory, and the RSI on the weekly has broken below 40 for the first time in months. This tells me that the big picture momentum belongs to sellers. Dropping down to the daily time frame, the picture gets even uglier for bulls. Price is sliced through the 5-day moving average at 4,558, the 10-day at 4,633, the 20-day at 4,628, the 50-day at 4,681, and even the 100-day moving average at 4,798. The only long-term average still below price is the 200-day moving average at 4,377. This is a textbook death cross territory on multiple timeframes, with the shorter period averages all sloping lower and acting as overhead resistance. The daily MACD is deep in negative territory at minus 34.63, and it is still expanding, which means momentum is not slowing down. The RSI at 37 is not yet oversold, leaving plenty of room for further downside before any mechanical mean reversion kicks in. On the 4-hour chart, we see relentless selling pressure with no higher low established. The 20-period moving average on 4-hour is at 4,628. And every attempt to push above it in the last 48 hours has been violently rejected. The MACD on 4-hour is showing a negative divergence cross with the signal line still pointing lower. Here is what most traders miss. The hourly chart is beginning to compress into a tight bear flag. The pattern is coiling right above the 4,444 support zone. A break of that flag to the downside opens the trapdoor. And on the hourly, the 50-period moving average at 4,681 is miles above, acting like a brick wall in the sky. Every time price even breathes toward the 4,550 area, it gets slammed. So the technicals are screaming one message: sell rips, don't buy dips, until we see a structural reclaim of 4,653. But here comes the cross-asset narrative that could turn this entire setup on its head. Let's connect the fundamental driver and the cross-linkage that most gold traders are ignoring. The 24-hour news cycle is screaming about gold prices dipping as the dollar firms amid a brutal bond sell-off and elevated inflation concerns. This is the key. The bond market is selling off, which means yields are rising. Rising real yields are the arch-nemesis of gold. When the yield on the 10-year Treasury rips higher, the opportunity cost of holding a non-yielding asset like gold explodes. That is exactly why the dollar is strengthening and gold is getting crushed. But here is where the trap is set. Elevated inflation concerns are not going away. We have an inflation supercycle narrative that just got revived by this very data. The analysis pieces hitting institutional desks today are titled exactly this: Gold pullback may be a buy zone in a new inflation supercycle. Smart money is not looking at this sell-off in isolation. They are cross-checking crude oil. Oil is the geopolitical heartbeat, and if oil prices remain elevated or spike further on supply shocks, that pours gasoline on the inflation fire. So while the daily trend is a strong sell, the 1 to 2 week directional lean becomes intensely dangerous for shorts if we get a fresh oil surge or a dovish pivot from any central bank speaker. The correlation model I run shows that gold and oil are starting to diverge, with gold underperforming oil's inflation premium. That gap typically closes. Either gold catches up, or oil crashes. Given that oil is holding firm on geopolitical fear, the risk is for gold to catch a sudden safe haven and inflation bid. So the cross-asset verdict is this: the dollar and bond sell-off are dominating now, but the inflation supercycle thesis is a sleeping giant. If the 4,444 support holds and we get a daily close back above the 20-day moving average at 4,628, that is the exact signal that the trap has been sprung and gold will rocket back toward 4,800. The invalidation for the bearish macro lean is therefore twofold: a close above 4,653 for the immediate tactical picture, and a bond market reversal that sends yields crashing and the dollar with it. Watch the 10-year yield and the DXY closely. If the DXY starts to roll over from its highs, gold shorts are on borrowed time. Now, this is where most people click away. They think the analysis is enough. But this is where money is made. I am going to give you 3 exact trade setups with price triggers, stop losses, and targets. Stay with me, because the level of detail here will separate you from the gamblers. Strategy 1 is the sniper, the conservative play for those who want to trade with the dominant trend and wait for a high probability entry. The trigger condition is a rally into the 4,617 to 4,628 resistance zone. Specifically, I want to see a 4-hour candle wick into that area and reject. The confirmation signal is a bearish engulfing 4-hour candle or a sharp MACD histogram. Rollover on the 4-hour. Entry on the close of that rejection candle with a target of 4,444 as target 1. Target 2 sits at 4,409. Stop loss goes at 4,658, just above the key resistance level of 4,653. The risk-reward on this setup is approximately 1 to 2 to target 1 and 1 to 3 to target 2. This setup is voided if we see a 4-hour close above 4,653. That is your invalidation. If price breaks that level, the sniper stands aside and waits for a new directional structure. Strategy 2 is the active trader, the standard approach that balances patience with aggression. The entry condition here is a sustained break and 4-hour candle close below 4,444. This is not a market order at the touch of 4,444. That is how you get caught in a trap. Wait for the 4-hour candle to close below it, confirming the structural break. Then enter short on a minor retest of the broken level, around 4,448 to 4,452. Stop loss goes above the breakout candle high, typically around 4,470 to 4,475, which gives you a tight and logical stop. Target 1 is 4,409, and target 2 is the 200-day moving average at 4,377. Once target 1 is hit, move your stop to break even and trail the remaining position using a 4-hour 10-period moving average as a trailing stop. The logic here is that a break of 4,444 opens the trapdoor to the last remaining structural floor near 4,377. If you are trading this, type break and retest in the comments now. Let's see how many active traders are in the room before I give you the high-risk aggressor setup. Here is your interaction cliff. Let's see how aligned we are. Type your gold price range for tomorrow in the comments right now. Give me a high and a low. I'm reading them, and I will pin the most accurate prediction tomorrow. This builds our community edge. Strategy 3 is the aggressor, for those who know how to lose small and manage risk with machine-like discipline. This is a counter-trend catch at the 4,444 support zone. The idea is to anticipate the trap before it springs. Entry condition: a rapid spike down into 4,444 on the 15-minute chart that immediately stalls and prints a long lower wick. You must see a sharp rejection with volume. Enter long on the very next 15-minute candle that closes above 4,450, which confirms the wick is holding. Stop loss is tight at 4,437, just below the support and below the psychological round number extension. This is a high-risk play because you are stepping in front of a freight train. Target 1 is a quick 4,510, which is the initial intraday resistance. Target 2 is 4,555, the area of the hourly descending trend line. If we see a move above 4,555, you can trail aggressively. But hear this warning: only take this trade if you are willing to lose the entire risk without flinching. This is a low probability, high reward snipe. If the daily trend is strong sell, you are fighting the tide. The invalidation is a 15-minute close below 4,437. If that happens, you exit instantly, and you do not add risk management. Pulse: never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events like CPI or FOMC minutes. Stops are non-negotiable. Every setup I just gave includes a hard invalidation. Respect it. As we close out today's gold briefing, the one level you must etch into your brain is 4,444. That is the line in the sand. Below it, we are targeting 4,409 and 4,377. Above it, and we start watching for the bear trap that could fuel a violent rally back to 4,628 and beyond. Tomorrow I am watching the bond market open and the oil inventory data, because any supply shock there will immediately feed into the inflation narrative and could accelerate gold's reversal window. If you want the full breakdown on the dollar index and the S&P 500 divergence, that video is live now. Click the end screen. I cover 8 assets every single day with this institutional grade framework, and you do not want to miss a session. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell so you never miss an explosive move. I will see you in the next one.